Earnings growth and profitability are always a challenge, but in 2015 the headwinds are many. A recent S&P report looks at the pursuit of global insurance profitability amid what S&P calls tempered economic growth. Here to discuss the hurdles to profitability is Patricia Kwan. She is a director at Standard & Poor's Insurance Ratings and joins us now from S&P's studio in New York. So Patty, what do you see as the most common headwinds to achieving profitability?
We see low interest rates, excess supply of capital, and tighter capital standard coupled with uneven economic growth prospects as common headwinds for many insurers around the world. Most daunting are life insurers operating in Western Europe that will likely see interest rates to stay lower for longer still. The other segments facing major hurdle is global reinsurers because of their inability to raise pricing amid an oversupply of capital.
So what are S&P expectations for profitability?
Globally, we see earnings clipping at around 6 to 7% for 2015 to 2016, with APAC, Latin America, and Central and Eastern Europe, Middle East, and Africa leading the pack. We are looking at around 13% year over year for APAC region, Latin America at around 18%, and CEMEA at around 20%. For North America and Western Europe, insurers' earnings growth rate is less robust, though steady, about 5% year over year through 2016.
Are there sectors better positioned for growth?
As far as upside earnings potentials is concerned, China, both non-life and life, Singapore offshore, Mexico P&C, Colombia life, and even U.S. health sectors are likely to be in a better position for earnings growth through a combination of strong premium, improved underwriting, and a relatively high investment yields.
How about markets or regions?
Typically, we see markets that are underpenetrated to have the biggest upside potential. These markets include China, Brazil, Mexico, Colombia, Thailand, and the Arab states bordering the Gulf region.
So let's get specific. Who faces the biggest challenge, and could the outlook affect ratings?
Yeah, we believe interest rate sensitive insurers, particularly in Western Europe with limited revenue diversifications, are likely to succumb to rating pressure. What we mean is that with interest rates likely to stay low for longer still in Eurozone, insurers searching for yield may lead to assuming additional credit, market, or liquidity risk. These insurers lacking capital to absorb these additional risks are more likely to see erosion of credit quality. Moreover, global reinsurers without a defendable competitive positions, or those that compete on price or by relaxing their underwriting disciplines, are also at risk. We also believe reinsurers displaying diminished capital buffer or showing ongoing weak earnings are more likely exposed to rating pressure.
If you'd like a copy of the full report on global insurance profitability, visit the S&P website.